Let's work through a transaction analysis example problem. So we need to analyze this long list of transactions for Peter's company, right? So there's a list here of some transactions. We're going to go through and figure out which accounts are affected and whether they're increasing or decreasing, and then by how much. So we set up this table, right, with all of the accounts that will be affected in these transactions. We have cash, accounts receivable, supplies, equipment, accounts payable, owner's capital, owner's drawings, revenues, and expenses. So now our first transaction. On June 1st, Julie Peters, the owner, invests $50,000 cash in the business. So which accounts are going to be affected? Well, cash is involved, right? Julie is putting cash into the business. So cash will be involved, and owner's capital because she's investing in the business. So both cash and owner's capital increase by $50,000. Now on June 2nd, paid $2,000 for June rent. So they're paying the money for this month's rent. So your cash decreases by $2,000 because you're paying that money, and your expenses are affected. Now we have more expenses here, right? So why is this a negative? Well, because your expenses decrease your overall owner's equity. So we show expenses as well as owner's drawings as negatives when we're doing transaction analysis. Now on June 3rd, we purchased $10,000 of equipment, paying $4,000 cash, and the remainders on account. So we have three different accounts that are being affected here. First, we are buying equipment, right? So equipment is affected. Then we are paying $4,000 down right here on June 3rd. So cash is affected. And then the remainders on account. So this is what we owe in the future, right? So that's going to be accounts payable that's also affected. So if we break down our three pieces here, $10,000 for equipment. So we show that we increased our equipment by $10,000. Paid $4,000 in cash. So we show that our cash decreased by $4,000. And then we owe the remainder on account, so our accounts payable increased by $6,000. Now on June 8th, Julie Peters withdrew $500 cash for personal use. So whenever the owner takes money out of the business for personal use, that's owner's drawings, right? So we show owner's drawings and cash both decreasing by $500. And again, we show owner's drawings as a negative because it decreases your overall owner's equity. Now on June 10th, performed services worth $5,000 on account. So if we performed services, that means that we need to count the revenue, right? We want to recognize our revenue when we perform the service. So our revenues increase by $5,000. And then it tells us that we performed these services on account, which means we will be receiving the money in the future. So our accounts receivable increases by $5,000 as well. Now on June 16th, purchased $400 of supplies with cash. So we went out and we bought office supplies, right? So our supplies increased by $400 and our cash decreased by $400. Then on June 20th, performed $3,000 of services and received the payment from the customers. So here we are performing services again, right? So we want to show that our revenues increased by $3,000. But this time our customers are paying us on this day. So we show that our cash also increased by that $3,000. Now on June 23rd, received full payment from customers billed on June 10th. So we take a look back on June 10th, and we billed our customers $5,000 back on the 10th. So here we are receiving full payment from them. So our cash goes up by $5,000 and accounts receivable goes down by $5,000. So you're saying that you got the money and people don't owe you that $5,000 anymore. Now on June 29th, you received a utility bill of $250 to be paid next month. So we need to count that expense in the month of June. So we show it under the expenses, and once again, we need to show our expenses as negatives because they decrease our owner's equity. And then we also show that our accounts payable is increasing by $250 because we will have to pay this utility bill in the future. So those are all of our transactions. So now we can start working on just totaling up each column. So if we total up our cash column, right? 50,000 minus 2,000 minus 4,000 all the way down, we end up with $51,100. So we have $51,100 in cash in the company. And now we just work our way across. Accounts receivable, well, we don't have anything left in accounts receivable anymore. Supplies, $400. Equipment, $10,000. Accounts payable, $6,250. Owner's capital, $50,000. Owner's drawings, $500. Revenues, $8,000. And expenses, $2,250. So we have all of these amounts here. What we can now do is fill in our accounting equation. So your expanded accounting equation is your assets equals liabilities plus owner's capital minus owner's drawings plus revenues minus expenses, right? Capital, drawings, revenues, and expenses. Those are the four pieces that make up owner's equity. But we can expand that out into each individual type of account. So we can expand this a little bit more. Our assets. Well, what are our assets in this problem? Those are our cash, accounts receivable, supplies, and equipment. What are our liabilities? Well, we only have one, so that's accounts payable. And then we have our capital, drawings, revenues, and expenses. Now we can start filling in our balances that we had. So 51,100 plus 0 plus 400 plus 10,000. Those are all of our assets. That needs to equal our accounts payable of 6,250 plus our owner's capital of 50,000 minus owner's drawings of 500 plus revenues of 8,000 minus expenses of 2,250. When you do all of that math, you'll see that each side of your accounting equation equals 61,500.